In 2008, millions of people thought they were being responsible. They bought safe homes, took safe mortgages, trusted safe banks, and then the safest decisions of their lives nearly collapsed the global economy. Here's the uncomfortable truth. Sometimes the most dangerous financial move you can make is the one everyone calls safe. Right now, across the world, people are doing what they believe is financially responsible. They're moving money into savings accounts, buying government bonds, paying off low-interest debt early, avoiding markets, avoiding risk. It feels disciplined, mature, smart. But beneath that calm surface, something else is happening. Because safety in finance is never absolute. It's relative, and it always has a cost. Let's start with something simple. Imagine you earn $1,000. You put it in a savings account paying 3% interest. You feel secure. Your money is protected. It's insured. It's liquid. You can see it in your app every day. But inflation is running at 4%. You are technically losing money. Quietly. Invisibly. Every single year. No red alerts. No crashes. No headlines. Just erosion. If inflation averages 4% and your savings grow at 3%, your purchasing power shrinks by 1% annually. That sounds small. It isn't. Over 20 years, that gap compounds. Your money grows, but your future shrinks. This is the first hidden cost of safety. Opportunity cost. When you choose what feels safe, you are also choosing what you give up. In the early 1980s, U.S. Treasury bonds were yielding over 15%. Locking in safe returns back then was brilliant. Inflation was high, but yields were higher. Fast forward to the 2010s. After the 2008 financial crisis, central banks slashed interest rates to near zero. In the United States, the Federal Reserve kept rates extremely low for years. In Europe and Japan, some rates even went negative. Investors searching for safety bought government bonds at historically low yields. They felt cautious, conservative, responsible. But when rates eventually rose, bond prices fell sharply. In 2022, U.S. Treasury bonds experienced one of their worst years in modern history. Safe assets lost double digits. People who thought they had escaped volatility discovered something unsettling. Safety is not the absence of risk. It's the transfer of risk. You remove one kind. You accept another. Now let's go deeper. Why do safe decisions often carry hidden costs? Because financial systems are built on incentives. Banks, governments, and institutions rely on predictable behavior. They assume savers will save. Borrowers will borrow. Investors will chase yield when yields are low. When everyone behaves safely at the same time, the system shifts. Take banks. When you deposit money, the bank doesn't store it in a vault. It lends most of it out. That's how modern banking works. Your deposit becomes someone else's loan. If everyone suddenly decides to play it safe and withdraw cash, banks face liquidity problems. That's a bank run. If everyone decides to play it safe and stop borrowing, economic growth slows. And when growth slows, companies earn less. Governments collect less tax. Jobs dissipate. Paradoxically, collective safety can create instability. Economists call this the paradox of thrift. When individuals save more during uncertain times, it makes sense personally. But if everyone does it simultaneously, total spending drops, businesses suffer, and the economy contracts. Your safe decision, multiplied by millions, becomes systemic risk. This isn't theoretical. During the Great Depression, fear drove people to hoard cash. Spending collapsed. Banks failed. Unemployment soared. In 2020, during the early months of the pandemic, uncertainty caused households to sharply increase savings. Governments responded with massive stimulus to prevent economic freefall. Because if too many people choose safety at once, demand evaporates. Now let's shift from macroeconomics back to personal finance. Consider paying off low-interest debt early. It sounds unquestionably smart. Debt-free equals safe. But suppose you have a mortgage at 2.5% interest, fixed for 30 years. Inflation is running at 4%. That means the real cost of your debt is negative. Inflation is effectively shrinking what you owe. If you aggressively pay off that mortgage instead of investing in assets that historically return 7 or 8% over long periods, you may be trading growth for comfort. Comfort feels good, but it isn't free. The hidden cost here is not financial ruin. It's slower wealth accumulation. And over decades, small differences compound dramatically. A $10,000 annual investment owning 8% over 30 years becomes roughly $1.2 million. At 4%, it becomes about $560,000. That gap is not about risk versus recklessness. It's about understanding trade-offs. Safety is rarely neutral. It tilts outcomes. Now consider the stock market. After major crashes, many investors swear they will never return. After 2008, retail participation dropped. Fear lingered for years. But from 2009 to 2019, U.S. equities experienced one of the longest bull markets in history. Those who stayed safe in cash missed substantial gains. Of course, markets can fall again. They always do eventually. But long-term data shows something consistent. Over extended periods, diversified equities have historically outpaced inflation. Safety in cash protects you from volatility. It does not protect you from stagnation. And stagnation, over time, can be just as damaging. There's another hidden cost few people discuss. Psychological anchoring. When you define yourself as someone who doesn't take risks, you may begin avoiding all uncertainty, even calculated, intelligent risk. You might avoid starting a business, switching careers, learning new skills. Financial caution spills into life caution. And in an economy increasingly driven by innovation, avoidance can mean falling behind. Look at companies that once seemed safe. Kodak dominated film for decades. It avoided aggressively embracing digital photography, partly to protect its existing business. That decision felt prudent at the time. It was catastrophic in hindsight. Blockbuster relied on its physical rental model while streaming emerged. The shift seemed risky. The old model seemed stable. Until it wasn't. At the national level, countries that cling too tightly to safe legacy industries often miss transformative waves. Energy transitions, technology revolutions, demographic shifts. Safety can become inertia. But let's be clear, risk is not inherently good. Recklessness destroys wealth. Speculative bubbles wipe out savings. The dot-com crash in 2000 punished blind optimism. The housing crisis in 2008 punished excessive leverage. The lesson isn't that safety is bad. It's that unexamined safety can be expensive. Every financial decision sits on a spectrum between growth and preservation. Too far toward growth, and volatility can crush you. Too far toward preservation, and time quietly erodes you. Right now, this tension is especially relevant. Interest rates have risen sharply in recent years. Bonds once again offer yields that look attractive compared to the previous decade. Savings accounts pay more than they did for years. For many, the instinct is to retreat. Lock in yields. Avoid uncertainty. But inflation remains unpredictable. Government debt levels are historically high in many advanced economies. Demographics are shifting. Technology is accelerating. The environment is not stable. It is dynamic, which means a decision that feels safe today may carry different risks tomorrow. There's also a political dimension. Governments benefit from inflation eroding debt over time. Moderate inflation reduces the real burden of massive public liabilities. If you hold cash, inflation works against you. If you hold real assets, it may work for you. So when policymakers tolerate inflation slightly above target, it isn't random. It's strategic, and that strategy has distributional effects. Savers lose purchasing power. Asset holders often gain. Safety, once again, has a cost. The deeper question becomes this. Safe relative to what? Safe compared to a market crash. Safe compared to inflation. Safe compared to long-term demographic decline. Financial narratives simplify risk into a single dimension. But real risk is multi-layered. Market risk, inflation risk, interest rate risk, political risk, technological risk. Avoiding one often increases exposure to another. When people say, "I just want to be safe," what they usually mean is, "I want to avoid pain." That's human. But financial systems do not reward the avoidance of all pain. They reward calculated exposure to productive risk. Risk is the engine of return. Lending money earns interest because there's risk of default. Investing in companies earns returns because there's uncertainty. Starting a business creates wealth because failure is possible. Remove all risk, and you remove most potential upside. So what is the real hidden cost of safe financial decisions? It is not immediate loss. It is delayed regret. It is the realization, years later, that the pursuit of stability quietly limited growth. That while you were avoiding volatility, inflation was working against you. That while you were protecting capital, time was compounding somewhere else. And yet, there is no perfect formula. The goal is not to swing wildly toward risk after hearing this. It is to understand that safety is a trade, a conscious trade. Every time you choose guaranteed returns, you are pricing in what you might have earned elsewhere. Every time you hold cash for comfort, you are paying for that comfort in potential growth. The system does not announce this bill. It simply deducts it over time. So the next time someone says, "This is the safe option," pause. Ask, safe in what sense? Safe for how long? Safe against which risks? Because in finance, the most dangerous phrase might not be "this is risky." It might be "this is safe." If this perspective challenged the way you think about money, take a moment to like and share the channel. It helps more than you realize. And before you move your next dollar into something that feels secure, consider this. Are you protecting your future or quietly trading it away? For years, we've been told that the safest path is the smartest one. Save more, risk less, avoid volatility. But now you know the deeper truth. Safety is never free. It always costs something. The only question is whether you're aware of the price. If this video changed how you think about safe money decisions, don't let it end here. On your screen right now is a video about why saving money can actually weaken the economy. It connects directly to what we discussed today. If everyone runs towards safety at the same time, the system shifts in ways most people never see. And next to it is a breakdown of how debt keeps growing even when people are paying it back. Because sometimes the system is built to expand, not shrink. Click one of these to understand the bigger picture. If you value calm, clear financial thinking without hype, subscribe to the channel. We break down complex systems in ways most people never hear about. Like the video. Share it with someone who believes playing it safe has no downside. And remember, the biggest financial risks are often the ones that don't feel like risks at all. I'll see you in the next one. So please like and share this video.